Hello, what's up, guys? Welcome back to Zodiac Trading channel. So, in this channel, we'll be sharing a lot of knowledge of investing and also about global macro trading. So, I'll be making a series of episodes explaining the fundamentals of investing, what you need to know, what you need to learn before you start trading stocks and maybe cryptos. So today's topic is we'll be covering the fundamental of hedge fund strategies because a lot of people will ask questions. What is a hedge fund? So a hedge fund, it's not something like really super complicated. You often hear this kind of term on the newspaper. You'll be hearing this kind of topic in Bloomberg from Bloomberg, and you will also heard of a lot of billionaires, ultra rich people are actually from the hedge fund industry. So a hedge fund, uh, it's a structure of a fund. It basically means that you can apply a strategy that you'll be able to long an asset and also be able to short an asset in let me explain the meaning of long and short. Long basically means that you're owning a stock, that you purchased a stock, and you have that kind of right to get dividend from specific company. And by the meaning of short, that means that you're selling a stock, that you no longer hold that stock, you decided to sell the stock for whatever reasons. So as a hedge fund, you'll be able to employ different strategies and you'll be able to trade, you'll be able to buy stocks and also sell stocks. You will buy those stocks that you don't like and you sell those stocks that you hate. And most of the funds, for example, like mutual funds, they don't really allow fund managers to sell stocks because uh, selling stocks could be risky. So that's why hedge fund strategy could be pretty much like diversified because it could be employed with both directions. So when you're short, you're selling stocks and you're hedging yourself when the market goes down. For example, today what you see on the news that you see S&P is down by maybe 10%. That means that's a big market plummet. A lot of people will lose a lot of money from the stock market. And because you're selling the stocks, that means you will actually make money when other people are losing money. That is the definition of hedge. That is the definition of hedging. That means that you're hedging yourself against the market risk because you're selling the stocks. Okay, so that explains the reason why we call this a hedge fund because you can apply both directions. You can hedge yourself against the market risk. You can, in the same time, long the stocks that you like and you sell the stock that you hate. That is the reason why we call this as a hedge fund. But you have a more of specific and sophisticated definition of a hedge fund. That means if you're a hedge fund, you have to be approved by SEC. Or maybe if your fund is operating in UK, that means you have to go through FCA, different regulatory bodies and different regulations. And that also means you need to have very high accredited investors. What does that mean, accredited investor? Accredited investor means very rich people. You have a lot of money to be put in on the liquid assets. You have enough of cash flow and you have good revenue that can support you to that you be able to bear the hedge fund strategies because investing in a hedge fund strategy could be risky but also could be very profitable. So to be able to invest in a hedge fund you must be a accredited investor and you have to um, put a lot of money in the fund. That means your money will be locked up for some time. So a hedge fund is a structure that you should be holding your money for some time. normally around 1 to 3 years. We call this as lockup period. So when you're investing, when you're chipping this specific hedge fund, your money will be locked because obviously you don't, as a hedge fund manager, you don't want to, your clients to withdraw all the time. That will just jeopardize your portfolio. And then normally a hedge fund would charge some fees. They call this as an incentive fee, meaning if you outperform the S&P index, for example, the S&P index is performing like, for example, 10% this year, and then you're performing like 15% this year, then you're 5% more than the S&P, that you're making this pure alpha of 5%. That means you're a good hedge fund because you have outperformed the market. And then you can charge that 5%, and maybe you'll be able to take 20% out of that 5%, and some really good hedge fund could be able to, they are able to charge like even 30% out of that 5%, and that becomes the income of the hedge fund. Some hedge funds also charge management fee because some really famous hedge fund, for example, like Citadel, like Bridgewater, they all charge management fee. So they normally charge like 2% of management fee. So that's like a typical, a classic 220 rule. We call this as 220 rule. So basically that means 2% of management fee and 20% of incentive fee. And then you have this high water mark thing, because as I have previously explained, you have to outperform the index. You have to outperform the S&P to prove that you have the ability to generate alpha. That's how you can be able to charge that kind of incentive fee. Okay, so here we can look at a little bit of hedge fund strategies. So there are different types of hedge fund strategies. As I have mentioned before, hedge fund could employ different strategies. So there are many different hedge funds applying many or say different specific set of strategies, and those kind of fund managers will be able to be consistently profitable in the market. So here you can see this overview. So you have, first of all, a global macro hedge fund. And for example, like Mr. Joe Soros, you've been a very famous and notorious hedge fund manager. He's a very good trader. He knows how to trade currency. And then he has a hedge fund called Quantum Hedge Fund. It's now becoming a family office. And then you have event-driven hedge fund. Event-driven basically means, for example, when you're operating a company, if the company goes bankrupt, or maybe that company has gone to several different set of merger acquisition, that could be called as event. So, and there are different kind of event, right? And you have macro event, you have corporate events. So if you're an event-driven strategy fund, that basically means you will make money, you will generate return out of this event. And then you have relative value funds. That basically means you'll be doing different set of arbitrage. You will be doing relative trades mostly. And then you have credit funds. Credit funds, that means you will be trading mainly credit-related products. And then you have long-short equity funds. You can long, and in the same time, they'll be able to short the equities. So long-short is pretty typical funds. Most of the hedge funds, they are long-short based. And that's the easiest kind of and most common hedge fund type. And then you have quantitative funds. That means that you're employing specific computerized strategies, that you're adapting different formula, and you produce all these consistent profit for your clients. And then you have multi-strategy funds. You have a fund that's accepting many different strategies. You have a couple of strategies that be included in this fund. And then you have managed futures. that basically mean that you'll be trading futures mostly. All right, so that explains the basic category of the hedge fund strategies. And then there are different number of the funds in the market. So they all look at different variables, and they have, as you can see, equity strategies is the mainstream. You have, according to the data in 2016, you have 5,000 more than, around 6,000 equity strategies. And then you have, only 156 niche strategies, 968 multi-strategy, 1,000 macro strategies, relative value strategy, that would be nearly 1,200. And then you have credit strategies of 1,300, and even driven strategies, which is the second biggest type of strategy. So as when you're making individual investment decision, that you have to look at several criteria. For example, first you have to look at portfolio diversification, and then you have to look at the risk management factor, and then the last, you want to look at the reliable return over time. So there are different variables that you should examine, and to be able to be a good hedge fund manager or whatever, to know about hedge funds, these are the things that you really need to know. Okay. So what is global macro? Global macro is that investment managers, they will use economic variables, and then the impact on this market, and they will use this as their own advantage to develop their own investment strategies. So managers, typically a global macro managers, I would say would be quite versatile, because they would be forced to expose to different market, different nations, and they'll be trading a variety of different products. So they need to have ample strategy, not only on the equity assets, but also the derivative markets and also in the bond markets. They need to be able to build good knowledge set to be able to trade a global macro strategy. So managers employ, for example, discretionary and systematic analysis. Discretionary basically means that you're using your own judgment, that you're using your own edge when you are trading. And then you'll be also applying quantitative and fundamental approaches, and you'll be holding and buying stocks, you'll be selling stocks, and you'll be holding, between long and short term, in different time horizon. And strategies will be based on future movements, and then that will be basically relying on your judgment of the economic situation. Event driven, what does that mean? That means if you're talking about an event driven strategy, that means investment managers maintain positions in companies currently or prospectively involved in corporate transactions, including mergers, restructuring, financial distress, tender offers, shareholders buybacks, debt exchanges, security insurance, or other capital structure adjustments. So managers would pursue strategies based on fundamental characteristics as opposed to quantitative and specific future developments. Position exposure includes combination of sensitives to equity markets, credit market, and company-specific developments. So basically, that means most of the event-driven strategy are focusing on corporate. I would say micro level on corporate sides. So you'll be focusing a lot of mergers, acquisitions. You'll be focusing a lot of restructuring, as I have mentioned before. So, okay, and then the next strategy is relative value strategy. That means that the managers would their judgment would be based on valuation and discrepancies in the relationship between multiple securities. So we'd be looking at different asset class, you'll be looking at the different securities. You were trying to find a correlation. You're trying to find if you can actually arbitrage out of it. So investments range could broadly across equity, fixed income, derivative, and other security type. Basically meaning that you're arbitraging and you're taking advantage of the pricing, mispricing mechanism of the system. And credit fund strategy. So credit funds invest in fixed income securities and mostly credit products, mostly like for example, credit derivatives, credit bonds, and etc. That means you're taking a large investment position and you're using ownership stake to participate in management of a company. Long short equity funds, the most typical and classic strategy of hedge fund strategies. So you'll be having a long position and in the same time be holding a short position. So the strategy can be broadly diversified or narrow, focusing on different specific sectors and can range in terms of levels of net exposure, leverage employed, holding period, concentration of market capitalization, and valuation. Ranges of typical portfolios. Quantitative funds, as I have mentioned before, this is a computerized strategy that you use computer models and you use to identify those investment opportunities. And then most of the modelers would, utilize different variables to program. They will have different formula, and then they will use algorithm, and they will use all these coding skills to make money for themselves as a portfolio manager. So quantitative funds are, all these kind of strategies are becoming like increasingly mainstream of the Wall Street right now because right now you have a lot of people who study in, quantum physics, for example. Guys who are studying very complicated mathematics, they have really good coding skills and really good sense of math, and they could start up their own quantitative funds. And then you have multi-strategy funds. You have different kind of multi-level of strategy, and when you're using multi-strategy, that really kinds of pushing these hedge fund managers to be able to understand the difference between different assets correlation and also the correlation between different strategy. So typically you'll be employing different strategy like, for example, convertible bonds arbitrage, long short equity, statistical arbitrage, and merger and arbitrage and acquisition and all these stuff. You could, put all these strategy into one of the specific fund set to generate more income for yourself. And then the managed future trading CTAs. CTA is a bit, really kind of profitable strategy because it focuses on trading. Commodity as a sector typically provides very good volatility. And CTA is a good trading strategy that could really kind of exploit that kind of volatility, be able to generate really good income, really good alpha because of the CTA strategy. So you'd be trading using futures, forwards, and then you'd be trading options contract, and you'll be basically buying and selling everything, including grains, gold, currencies, stock indexes, all these macro stuff. And you can go long and you could go short, and that's why future is a very, very liquid product, the very, very liquid financial product that you'll be able to trade, you'll be able to execute your trade, be able to be profitable in short period of time. And then, okay, to sum up the entire show and the section, you want to know about like hedge fund could apply different strategy set. And as an investor, it's very important to understand the difference between different hedge fund strategy. It doesn't matter if you are a graduate student who major in economy, or maybe you want to be a hedge fund in the future, or you're already a hedge fund right now, but you still want to know the difference between different strategies, or maybe you're an investor who wants to know the niche of the financial market. In this episode, we talk about hedge fund strategies, and hopefully they be able to help you to expand your view, to really help you understand the depth and the inside and out of Wall Street. Okay, so thank you guys for watching. I'll see you in the next episode. If you like my content, please support, subscribe, and click that bell button, and so more people can, can see the same thing as you do, to be able to also be able to see my show, and more people would have good knowledge of Wall Street to be able to master their own finances. So thank you guys for watching. I'll see you in the next episode. See you next.